So I want to talk to you about definition first. How do we define value? And we broke it up into 3 pieces. The first piece is expected value. So just by having insurance, even if I never make a claim, I may have a different way of approaching things. There may be a change in my behavior. I might feel more peace of mind. So just having insurance gives me value. The second piece is service value. And by service value, what we mean is that often insurance is linked to services. They can be cashless funeral services, they can be health services, and they can be services provided in the process of selling insurance, such as financial education. But the piece that we felt was really missing was the financial value. So this actuary's guess, how can we kind of fine-tune a mathematical calculation so that we can better understand the value that people obtain? And the way that we start thinking about that is, what is the cost of these events, of different shocks to people? And then how do they finance these events? And we know that people finance events in different ways. They can use savings, they can borrow, they can reduce investments, they can do nothing. And what we really want to understand is, where does insurance fall into this? What does insurance, how does it interact and play? So the next piece was, how are we going to measure this? So we have a sense of the definition of value and financial value in particular, but how do we measure it? And traditionally, people will have focus groups with clients. We'll call clients into a location, sit them around in a room, and ask them questions about, are you happy with insurance? And most typically, the response will be yes. And the response will be yes because we picked the best clients, or the ones that showed up are the ones that are going to say yes. And that doesn't really give us what we want to know. So we developed a methodology that we call client math to try to get at this a little bit more rigorously, even though it's still a qualitative methodology. What it tries to do is to quantify the costs. So how much did you spend on your funeral, for example? And then understand how those costs were financed by low-income people. And we ask, how much was the food at the funeral? How much was the flowers? How much did you pay for the chairs, the priest, or whatever else was involved in the funeral costs? And then how were those financed? And we come up with a very nice mathematical calculation to understand. And we talk to people with insurance, we talk to people without insurance, and we really randomize the sampling as much as we can. People who have had different types of events. So we did studies in health, both inpatient and outpatient health, in Africa, Latin America, and India. We did 4 studies in property across the globe, and those were really focused on the effects of floods on low-income households, not agriculture necessarily, but it was more businesses and livelihoods. And we looked at life insurance also across the globe using this methodology. And the first thing that I wanted to share with you is, how much did it cost? Because that was our first question. How much are these shocks costing you? And what we've done here is we've indexed these costs based on the household income of the families that we spoke to, so that we could compare a household in Colombia to a household in the Philippines to a household in rural India. And what we find is somewhat expected, that outpatient health care that is typically frequent but low cost was only about 1.5 weeks of household income, whereas funeral was over 8 months. So it's almost a year of household income that goes to paying for a funeral in a low-income household. And then you've got the flood and hospitalization that are a little bit less, somewhat in between, with 1.9 months and 2.2 months of household income for the costs. And I want to highlight a couple of things about these cost calculations, because as much as we tried to be very precise, the methodology does miss out on a couple of things. The first thing is with floods. This 1.9 number is probably a little bit low. The reason it's probably a little bit low is that we found that people don't rebuild their homes. They don't rebuild them right away. They may fit a new roof just to kind of keep the rain out the next time, or start building new bricks, little pieces at a time. But it's done over quite a long period, and those costs are not always quantifiable in a short period of time when we're doing those interviews and trying to understand. The other thing that we've noticed is not all labor is paid. So we did speak to a lot of women who have very high opportunity costs when something happens, but it's because they're doing unpaid labor in their homes. So that's not quantifiable when we start calculating the indirect costs of some of these shocks, because they don't get paid for it. It's hard to put a number on it. The other piece is when we do these interviews, we do it at one point in time, and we do ask over the last 3 months or since the shock, how much did you spend and how did you finance? But they're not longitudinal studies. So we're missing some of the long-term effects. And the other piece that we're missing is borrowing. So what happens when somebody can't pay for a loan in the long term? Do they get shut out of the credit market altogether? Are they able to borrow again? What happens to their interest payments? And those types of things, again, are not easy to measure, but probably add costs to the shocks that we looked at. So the next piece is, how do they finance these costs? And what role does insurance play in that financing, both for the insured and, for the uninsured, not insurance, but how do they finance? What we found is that the way people finance these costs has a lot to do with what's available and how burdensome those strategies are. So the first thing that somebody will do is kind of reach into their own pocket. They'll use their own income or maybe cut spending in their household, something that's relatively accessible to them. And we found that that was quite frequent, and about 61% of all the people we spoke to across our studies, it was over 1,000 people, had used this. But the problem with this strategy is that it's usually not enough money. For some smaller events, it might be enough money, but typically it doesn't cover some of the bigger costs. And so people have to go to the next level, the next hardest level. And the next hardest level is something close by, your community, your family, your neighbors. And they can either give you gifts, which in some cases they do, and in some cultures is quite common, or lend to you. That's not always enough either. They're just as poor, and sometimes they don't want to. So then people go to the next hardest level. And that typically looks like formal borrowing or perhaps savings that they have in a bank saved away for something. This is where we find that access starts to become much less common in certain settings. Not everybody has savings. Not everybody has access to formal loans. And savings tend to be quite small, the amount of money that's saved. We had about 28% who used this. And so in the cases that these are still not enough, people will sell an asset. And this is what they really try to avoid, because selling an asset is hugely inefficient. It's very difficult that that asset is going to match the cost of your financial shock. And so sometimes you might sell something worth a lot more and kind of inefficiently finance it. And it typically is a productive asset or something that you would use to earn income, and you lose that when you sell it. And so it's really something that has a greater level of burden. And we see people really hold out to avoid that, and a smaller number of people use it. I want to give you the example of financing funerals to start with. And I'll go kind of slow, and then we'll speed up with the other ones. So we measured the insured and the uninsured. How did they finance these funerals? So the first piece, and with funerals we see this as being relatively common, especially in more traditional cultures, gifts is a big piece. In the Philippines especially, there are kind of social mechanisms where community members come together and help finance the funeral in kind and in cash through a number of different mechanisms, including gambling. There's a pot where people throw money, they give money, family members contribute to buying things like food. So there are a lot of ways, and it really does help finance the funeral. The next one is their own income, which is typically quite low compared to the needs. And this is all in, it's indexed in months of income as well. So now we got to about 4 months of household income. The next one is informal loans, so borrowing from those neighbors, borrowing from your family. And we start to see that the insured are doing less of that than the uninsured. Reducing spending, it's kind of tough to do that, and people will hold out, especially for these large issues. Savings. People just did not have a lot of savings. And so even though we would expect it to be a large source of funding, it really wasn't. Formal loans, also difficult to have access to formal loan. What bank is going to lend you money for a funeral? And so what we find is, especially the uninsured who had higher overall costs because they didn't have insurance, they start to sell assets. And we do see that for these large expenses, these more burdensome strategies, including loans and selling assets. This is the insurance coverage here. So you can see that for a relatively small premium, the insured were able to cover a lot more of their costs, and even more perhaps than what the funeral cost them, which is not a bad thing when someone dies, because often that person is an income earner. And so their income is missing, and some help has to go to the family to continue their livelihoods. They didn't use fewer mechanisms. The insured weren't able to completely avoid, on average, using all the same mechanisms as the uninsured, but they used less of each. With property damage, we see a very similar, if not much more exaggerated situation where everybody used the same mechanisms. The insured did use less of each, but it was a much smaller difference. The annual premiums were still relatively small. One of the things I want to point out, though, with property damage that we found quite interesting is that having insurance seemed to have crowded in some informal lending. So people who knew they were going to be getting a payment with their insurance were more easily able to access loans from their community than those who didn't. And that kind of makes sense, right? They're good for the loans. If they've lost their business, it rained, they lost everything, and they go ask for money, it's unlikely that anybody thinks they're going to get their money back. But if they know an insurance payment is coming, they may be more likely to lend to them. For hospitalization, we see slightly different patterns. And I think one of the really useful things to think about is that hospitalization coverage really does, and you can see these overall costs, it really does reduce the overall direct costs of getting care, and thus the financing needs. We also see, again, that everybody's accessing the same type of mechanisms. Very few people are able to avoid using loans, for example, but they use fewer loans. And again, for a relatively small annual premium, they're able to reduce the amount of the burdensome financing with insurance in a way that those without insurance aren't. The story changes a little bit with outpatient care. If you remember that first slide, outpatient care was a very low cost. It was a week and a half of monthly income. It's not a big deal. And it's so not a big deal that you may not even want to go get insurance for it. You may think, I'll just reach into my pocket. And that's pretty much what the uninsured did. They reached into their pockets, and they, with a little bit of gifts and some of their own income, they were able to finance most of that need. So they didn't really need the insurance to reduce their financing. And you'll see that even more in a moment. These are some of the other tools that people used. I want you to look at the insurance coverage, which was pretty significant. So it cut a lot of the direct costs of that outpatient care, albeit small costs, but at this premium. So when the client is doing the math and thinking, should I buy insurance if I get sick and I have to pay this much and I get this benefit? And in the end, it kind of starts to look exactly like the cost that the uninsured finance. So what's the point? What's the value? What's the benefit? To us, this is one of the most exciting findings, even though it looks kind of depressing at first. And the reason for that, is that in our client math studies, we actually saw people behaving differently because they had insurance. And in ways that if they had financed these illnesses with savings or loans, they may have not behaved this way. So for example, we call it use it or lose it. I'm insured, and so I'm more likely to go to the doctor sooner when I have some symptoms than wait, because I've already paid for this. I've paid for the doctor's visit, so I may as well use it. If I'm going to use my own savings, or if I have to borrow or sell something, or even reach into my pocket, I may wait it out a little bit and see if I get better on my own, or buy cheap medicine and hope that I get better on my own. And so that's a really interesting incentive, a behavioral incentive that we see with insurance that we really don't see with other financial tools. We also saw in a study in Nigeria where the insurance covered chronic disease that people with insurance, again, the savings wasn't huge and it was bigger than expected because there was a subsidy on the product. But what was really interesting is those people who were insured were going regularly to their doctor. They were regularly on their hypertension medication compared to the uninsured because they had access, they paid for it, they could use it. And they made dietary changes because that program also included some education and counseling that helped people understand the kinds of diet changes they needed to make. And we actually were able to quantify how much more they spent on healthy food than the uninsured, which was really exciting. And I think a really interesting case for this kind of care, even though you don't really save a ton of money. So, what is the role of insurance? What is the role of insurance in financing shocks? Well, our hypothesis was that it was going to reduce the number of mechanisms that people were going to be using, that it was going to be this great bonanza product that was going to completely alleviate the need to go anywhere else, and it isn't. In fact, what we find is that the number of tools that people use is much more related to the severity of the shock, the size of how much they need to finance, than to whether or not they have insurance. And that kind of makes sense for a couple of reasons. One is these insurance policies are not huge. And secondly, they just don't have access to a lot of tools. And so they use every possible tool that they can. But what we do see is that even though they use the same amount, they use less of each. And that is a relief. So what did we learn about financial value? Firstly, microinsurance has to be affordable. It has to deliver on its promise. That's the first step. Otherwise, we can't even get to the value piece or the value discussion. But value is more than that, and it's more than just thinking about the premium in relation to the benefit. The second is, as we've seen, it's not the total solution for managing risks. It has to be part of a broader set of tools that are available to people. But it can very much complement those tools, and it can relieve the burden of using some of those tools. And finally, there's something particular about insurance that can be more valuable than some of those tools. In the case of health insurance, as I was saying, there could be this use it or lose it kind of incentivizing where people use health services, especially at the preventative or early stage level, more than if they didn't have insurance. We saw also the frugality where people might tighten their belts a little bit more in the short term because the overall cost is smaller, and by reducing household expenditures, they may be able to get by. Whereas when the cost is much larger, it's not even worth it. You have to get a loan anyway. You might as well finance a larger amount with a loan. So we see some frugality. And we also see this idea of crowding in loans from people in the community as a way of complementing the financing because they're expecting an insurance payout.